Maybe what we need to do is go to local governor Todd Halterman. Maybe he could tell the Fed what they need to do. Good morning, Todd.
Good morning.
So, what is the Halterman crystal ball say for interest rates? What do you think, or what's at least driving these things?
Well, I mean, we're looking at the velocity of money across America, and the velocity of money is measured by when money leaves a bank and it goes out to a business or to consumer and it gets spent or paid to somebody else. How quickly does it make a full circle from going out till it comes back to that same financial institution? And generally, money will change hands 5 times before it makes a complete circle of velocity. And with interest rates being aggressively high, like they've raised them, that's obviously slowed the lending down a little bit because people are more reticent to borrow at current rates when they have old rates. So that slowed things down, both from growing businesses, but also from buying and selling real estate. We've seen the market not really retract, but flatten at this point from loan volumes. And when money slows down and growth slows down, people speculate. When Goldman Sachs would generally make $100 million trade on Wall Street, the market generally doesn't move. Today, when we're seeing $100 million trades from organizations like that, the market's bouncing all over the place because the volume is certainly down. IPOs have slowed down. Mergers are starting to pick up, where you're seeing larger companies and conglomerates picking up smaller conglomerates. So the component of interest rates rising has slowed down because inflation is working. If you go to the grocery store, you're seeing consumers' purchases at the grocery store is 50%, if not higher than it was a year ago. But in our opinion, when we're looking at the marketplace right now, interest rates will stay pretty steady where they're at right now. We do believe there will be one, if not two more bumps, if the corporate America and Wall Street continues to show big profits. And that's just to continue to keep things slow so banks can recapitalize while they're in this period of not having large reserves and people not cashing out old loans as fast as they were before, until life gets in the way and people are forced to move and forced to change jobs, and things that force people to actually go out in the marketplace and get used to the new interest rates. So I think they're going to pump the rates up a little bit or keep them the same for the first half of next year. And it looks to me like they'll use the interest rates to help get the economy moving again as the recession cycle moves through itself and things continue to be slow, and they'll speed it back up. But let's remember, Ron, we've got an election year next year, and Americans have short-term memory loss. And I believe a lot of politicians hope that they forget the pain they caused the last 3 years. And then they're going to save our life next year by giving us more competitive rates. And then I think we'll see real estate values start to take off again, especially in certain asset classes. But real estate is poised to grow. So if consumers are worried about whether to buy right now, it's the time to get out and start looking to buy.
Interesting. Okay, so now it's interesting that the commentary that you've got there, because I've been sharing a little different thought, but along the same lines. So I'm going to throw this at you. California is already at a 4.6% unemployment rate, even though, and that was before the last BLS numbers. I haven't seen the newest California unemployment, but now we're up a 0.5% over the lows on unemployment. And that generally indicates that we're heading toward a recession, which would be contra to raising rates, wouldn't it be?
Well, the labor market's slowing down, and that's really a sign of manufacturing getting more efficient. We've seen that time and time again. But even at 4.5%, we're not in a range of what I would say having economic volatility. Corporate America is still profitable, but the signs look to me like sector recoveries, not a full-blown recession, because of the profits that we're still seeing.
What is sector recovery, Todd?
Well, that means that there's different sectors of the world. So you have industrials and manufacturing and consumer services, different areas of the global economy. But right now, they've been recovering at different rates in different areas. So it hasn't been everything all at once. Um, I'm still not convinced we're going to have a full-blown, what we're used to as a full-blown recession where we see a huge downturn in the market. There's still a tremendous amount of cash out there in corporate America, and profits are really strong. So there's a lot of mixed signals right now. But if you're watching the interest rate market and the fixed income market, the bond market has really started to stabilize. I'm seeing a lot of institutional money go back into fixed income in droves. There's some good risk-free returns out there. So it's confusing, Ron. It's very confusing, and it's why we're using a lot of tools to help protect people's principal right now while we still guard the inflation growth.
So I want to talk to you about the interest rate market when we come back. But before we go, I want to just throw this out there to you, because I hear this a lot on the news. I just had this conversation with an investor this morning. Why in the world would somebody invest in the stock market right now if they can go and go to something like the U.S. government and get 4.5% on a 10-year Treasury?
Well, again, it goes back to risk profile and what kind of growth do you want to expect. But I look at areas of the world like aerospace and defense and cybersecurity and innovative technology and AI robotics. And if you close your eyes and open your eyes up 10 years from now, those industries are 5 times bigger than they are today. That's how you keep up with inflation.
Makes a lot of sense. We're going to continue our conversation with Todd Halterman when we come back. Continue our conversation with Todd Halterman. He is one of our favorite veterans. Thank you for your service, my friend.
Oh, thank you.
Glad to have you with us, and we're happy to honor you this week during our Veteran Appreciation Celebration all week on Ron Siegel Radio. So I'm glad that you were able to join us, my friend.
Me too. It was a great morning to do it.
Yes, sir. So I want to chat with you. We were talking in the last segment about interest rates, and I noticed it from the Mortgage Bankers Association in their report that came out this morning that they're talking about refinances rose 2%, and now they're down 7% year over year. And last year they were down about 80%. So, going up, being down, those numbers, they're still on top of some pretty bad numbers. But my question is there value or emotional value when people start saying, okay, mortgage rates are in the high 7s, low 8s, and they've been there for about 60 days now? There's not a whole lot of the fact that there's stability. Does that help in the interest rate world as much as it does in the stock market world?
Well, and you understand the interest rate policies in the last 15 to 20 years changed significantly due to quantitative easing. So much like inflation, interest rate market is being used to help control the velocity of money and the expansion of business. So if rates, really what the Fed is saying is that they think they're going to keep rates and inflation fairly high for a while. The inflation is to help inflate, obviously, purchasing power and the cost of goods sold. Coca-Cola, if they sell $20 billion in soda pop and they raise their prices and now they bring in $25 billion, but they maintain their 20% profit spread, their net profits are 20% larger just by economies of scale. That's why you see the capital markets and the stock market, if you will, generally expand significantly after an inflationary cycle, after this shock of the inflationary cycle goes on. But when you have a shrinking labor force, which higher unemployment and higher cost of living and higher interest rates, life gets way more expensive for Americans, and Americans lose confidence. So the interest rate game is being used to help slow down that money, to slow down the economy, to stabilize itself so banks can catch up to all the lending they've done the last 4 or 5 years, and for the real estate market to build equity back up so consumers can have a balanced balance sheet. But let's be honest, Ron, this move is so the government can collect more taxes. If they don't sell any more goods and services than they did last year, prices are higher, taxes will be higher. That means it costs more for Americans to live. So it helps the bottom line for them to balance their budgets or get caught up to the budget that they like to spend. But the interest rate market is a key indicator on how the government wants the economy to expand. So if we can see interest rates come back down, you'll see real estate markets take off. You'll see the bank markets take off. You'll see the stock market take off. So the tide will lift all boats. But right now, everybody's hanging up on interest rates because it's slowing life down.
Well, but doesn't that become a catch-22 then? Because if they lower interest rates and everything that you just mentioned takes off, and I agree they 100% that they will if they lower interest rates, then doesn't that going to be the create more inflation? So the Fed's going to come back in and say they want to start raising rates again.
This is why they're going to hold inflation pretty steady where it's at right now, and we believe. And the interest rates will be the measurement of how money is going to move. And inflation being higher is actually a positive thing. Frankly, consumers and Americans and even retirees are actually finally making some interest on their cash where they haven't been able to make any interest on their cash for 10 to 14 years. So it's nice to be able to hold money in treasuries or even in money market and make 4 to 5%. So inflation is not bad. Combining it with high interest rates has made it difficult for sure, especially for people on a fixed income.
Do you think we're going to have a big come to reality in the next, 4 to 6 weeks, where people have, their money's tighter, gas prices have been high. We're seeing some people having trouble with not a lot, but some more unemployment. But the items that the government doesn't monitor in their core CPI numbers are
Right.
high. And, Thanksgiving is going to cost a lot more this year than it did in the past. Is that going to have an effect?
It's going to be double. You go to the grocery store. I bought an apple yesterday for $1.81. A golden delicious apple for $1.81. There's no question consumers are having to figure out how to afford basic staples like gas and oil. Food, those are not counted in the core CPI. And that was during low interest rate environment is really how the government was helping to slow people's spending was by driving gas and oil higher, which raises the cost of food and groceries and consumable goods because it costs more to truck them to the stores. So there's a few manipulations going on in the world right now that's really causing the Americans to slow down their spending, using their credit cards, reducing their savings. And for that reason, with global war and the threat of war and natural catastrophes happening more, there's a macroeconomic risk of the market having downturn of 10% or so. And I think Americans need to be used to the fact that the market's going to move on them at any given time up to 20%. But 10% is almost a given at this point because the market expands and then it takes it back. The market expands and it takes it back. So for the next 6 to 8 months, 3 quarters or so, we believe the market is going to hit resistance points. It's going to go up and hit a point and then come down and hit a point. And we're going to tread water with some what I'll call insignificant returns for the risk people are taking. But that's why the bond market is looking so attractive right now.
So I don't want to get into, I know we don't give any financial advice on Ron Siegel Radio. They can call you for that individually. That way they can get the risk profiles and everything else that you need from a compliance standpoint. But just as a layperson, I hear, we're giving $100 billion to Ukraine and 15 or $20 billion to Israel, and we give all this to everybody from the sense, and I know many instances we're not giving them money, we're giving them military items. It seems to me that just as a layperson, that sector should be a great sector to be investing in because the government's saying, we're going to spend all this money there. Am I missing something?
No, not at all. And when we sit down with folks and help them understand and have a relationship with their money, we really write job descriptions for people's money. And gosh, if you close your eyes and you look 10 years out and you think about how different aerospace industry is today than it was 10 years ago, to how different the Department of Defense does defense now through cyber attacks, lasers, space, satellites, even the planes and tanks are not manned with people anymore. They're drones. So I believe that people need to be aware of how to invest in specialty markets instead of buying the entire stock market itself. We need to look at industries that we have confidence in that's going to expand. And to me, things like cybersecurity and aerospace and defense, AI, robotics, and technology, those industries look to grow by 3 times over, if not more, over the next 10 years, just based on the new world and how we do business today, especially after COVID.
Yeah, it's pretty amazing watching some of these things. And I've been watching, I watch some stocks, and again, we're not going to give any advice, but You look at a company like Microsoft and Apple. Well, Apple's been doing the same thing over and over again. They just keep coming up with another version of an iPhone for somebody to spend a couple $1,000s on. And Apple, as you mentioned, with all of their AI stuff, I'm sorry, yeah, Microsoft with all their AI stuff, they're pretty close to an all-time high on their stock prices. So you got to wonder, which way do you want to go? Even though Apple's been such a great stock for so long, but again, you got to have a plan there. And I'm going to recommend that something, unless you're doing this full time, and I wouldn't consider that I don't do it full time. You got to call and talk to somebody that is doing it full time, and as Todd mentions over and over again, he's got the support of a lot of people that are feeding information to him that the average individual doesn't. And no matter what we say, any information that we get is biased, right? As a lay person, where do I go to get information? I'll watch CNN, I'll watch Fox News, I'll go to Bloomberg, I'll go to BBC, I'll go to local stations. And I know every one of those has a bias. You got to hope that some of the financial analysts are just looking at the numbers and the business and feeding information to the professionals like Todd from an unbiased standpoint, not from a Democrat lens or a Republican lens or any of those things. So make sure you're taking care of your family that way. It's really, really important. Continuing our conversation, Todd Halterman is with us this morning, chatting about the markets, where money's going. We're talking about interest rates. Are they going up? Are they going down? Todd's firm seems to believe they might go up another time or two. Todd, do you have any idea when that might be? Are you talking early next year, late next year? What's your time horizon?
It's really predicated upon consumer confidence in the capital markets. The Fed has said we're likely to hold rates for a while. They want to bump it up one or two more times, but because the employment and labor numbers, as you mentioned in the last segment, and unemployment's going up, so they've slowed down raising that interest rate, allowing the oil and gas markets, the food markets, the things that aren't measured with core inflation, allowing the employment and labor statistics to finish the year out. The economy, the government also wants to see how consumer spending handles through the holiday season. As you know, year end, they watch big time what consumer confidence looks like on how much they spend on the holidays. So there's just a lot of things to change. If we're looking from a 30,000 foot view, it looks to us like we should see one more bump in interest rates sometime in the first quarter of next year. We don't really see that economists think there's going to be two of them. But if things heated up for some reason and the markets start taking off, it wouldn't surprise me to see one, if not two, raises in that first quarter, second quarter of next year. We think inflation is going to stay right where it's at. I think oil and gas is going to stay right in the neighborhood that it's at, going up a bit, going down a bit, especially through the winter when consumption goes way up from heating bills. And then the second half of the year, it looks to me like towards the end of next year, we should see mortgage rates come down a little bit to help stimulate lending in the economy and banks and capitalization there. And we should see the Fed rate come down just a little bit. But we don't see a real aggressive moves. We think that a fair mortgage rate is going to be in that 6.5% range once they stabilize interest rates after the election. But these are all guesses based on economic input from some of the best economists that we follow. And these are just estimates, and we guess that the marketplace could look more stable from an interest rate and inflation market in 2025.
So let me ask you this, based on what your estimates there are, is there any historic value to, or do you not have knowledge of what's happened historically in interest rate environment? Do you think the Fed would really increase interest rates going into a presidential election?
Well, if their goal was to slow velocity of money down and keep the markets from taking off too much because of the high inflation, that's where the Fed is just not really showing their hand. There's a lot of factors going into their decision to sound indecisive, but I think it's really to try to keep consumer confidence low and to keep it vague, so the markets don't take off too much, because I don't think they really want to. But frankly, if they need to, it's not a bad thing short term. Long term, we all know that they want voters to go to the poll with confidence. But if they do a shock to the interest rate market and then they bring rates down by 0.5%, even right prior to election, you and I both know what that does for the velocity of money and lending. And we'll see a lot of activity going into the end of the year. So it's very plausible that we're going to see it stay the same or maybe one raise, but it's very, very plausible. And I think very possible that we'll see a little bit of rate relief going into the end of the year.
Yeah, it wouldn't surprise me because I can't imagine, they seem to be wanting to stay completely out of anything to do with the fiscal side, right? I mean, because they won't even come out and say that all this spending that the government's doing is what helps cause inflation. So I can't imagine why they're going to get involved in wanting to influence an election by either going up or going down. So it seems like we may be in a stagnant rate environment until this time next year after the elections.
I don't disagree with you, and it's really, we call it range bound. We think the capital markets, the income markets, the financial markets, we think they're going to be range bound for the next 3 to 4 quarters, which means they'll peak and trough in between two certain points. And it's been a stock pickers market this last year. It hasn't been, an overall bullish run. The market's expanded and it's retracted the last 2 months. So your average index investors are getting anywhere from 2 to 4% returns, but they're taking 20% risk to do it. So it's been good to hang on to cash. And, a lady can't buy things on sale, Ron, if she doesn't have cash in her pocket.
And I just saw this morning that the credit card debt is way up there also. So might be starting to max out those credit cards and can't use the house as a credit card right now. So it may be an interesting next 6 to 12 months. We'll see what happens. But I appreciate you, Todd. I appreciate you coming on and kind of shedding some light, maybe help us understand what's going on in this world. And as always, I want to say thank you again for your service to our country. We couldn't do shows like this if it wasn't for the men and women that go out there and fight for our country. So thank you for your service and for the rest of the men and women this week as we honor all of our veterans.